Hi, everyone. Just before we get going, I want to remind you that everything we talk about and discuss should not be considered as investment advice. The purpose of what we talk about on Catherine Murray Media and Markets on YouTube, as well as Catherine Murray in Conversation With on my podcast, should be viewed as informational and entertainment purposes only. Please definitely do your own research, your own homework, and definitely consult an investment professional before making any investment decisions. And also to note, some of us might hold positions in some of the stocks that we discuss. Gord, great to be able to catch up with you. So appreciate your time. And there's certainly a lot going on in the markets right now. Of course, we've seen the markets down yesterday by about 2% on concerns out of China with Evergrande. And then we've got the Fed meeting tomorrow. Maybe give us a little bit of perspective in terms of, what you think is a real concern or perhaps not.
Well, I guess right now, and I mean, every time I answer this question throughout time, the issues of the day really seem to resonate, Catherine, and the test of their importance is perhaps that 4, 5, 8 months later, do you remember those issues? And more specifically, do you remember the timing? And often the answer is no. So they tend to be quite transitory. But without question, there are a lot of overhanging issues to today's market, and obviously the biggie is COVID and the Delta variant and how long it's going to stick around, and as it relates not to just health but to the economy and the markets. Is the dislocation that we're seeing so evident on the supply side and the demand side going to work its way through quickly, or is it going to be more difficult to get through it all? And then, as you mentioned, we've got the Fed and monetary policy and the Fed's desire, and I think they've telegraphed it quite well, to raise interest rates, or at least to start tapering from their $120 billion a month quantitative easing program relatively soon. They haven't given us an exact date, but we know that it's coming, and the market is digesting that. And then, of course, on the fiscal side, we've got a debt ceiling debate, and we've seen that movie before. And I fully expect that that's going to create some angst in the market, although these things always get solved. It's just the negotiation process that has to take place, which takes us to the 11th hour of stonewalling and threatening. And then, as you mentioned, we've got China and possible burgeoning issues with credit quality of a major property developer. China is making some pretty big overtures in terms of societal changes, which I think have some reach, but not huge reach, to be honest with you. What have I forgotten, Catherine? There's certainly more.
Well, there is more, and I'm almost surprised at myself that I didn't start with this, but there's obviously a reason, which is the Canadian elections, which just ended last night. I did election coverage for the News Forum for 6 hours, and it's so status quo. Although we just spent $600 million on the election, so I didn't start with that. But what do you make of it?
Well, you spent 6 hours, and they spent $600 million, and it was all for three seats on the Liberal side. So I think, as a lot of people thought, this was going to basically end up in a stalemate. People other than myself certainly know this area better, but it seemed to me that the conservative, the right-wing conservative element sort of stole some of the thunder from the Conservatives and didn't allow them to make it a little closer. I think there was a backlash against Trudeau for calling the election. I don't think that he really looked that good in posturing for a new government in the middle of the election, and that was discussed almost ad nauseum. But here we are. How it affects markets, I'd say not very much. We didn't see much move in the Canadian dollar. It firmed a little bit, but I don't think it's going to have any effect on world markets or the U.S. market.
Mm-hmm. And so when you take a look at those major drivers of, market sentiment, but also, of course, what we end up seeing from an economic perspective, specifically China and perhaps some of the slowdown that they're seeing and whether or not there's going to be credit qualities with this property developer, where does that leave you in terms of your client's money? And perhaps how much risk you want on, given the fact that there's not a lot of other places to invest, Tina, there is no alternative, or is now the time, or have you been taking money off the table, just given the fact that all of those issues are at play, and also, of course, we've got seasonality.
Well, the way we run our client accounts is that each client has a risk-reward profile that's defined through an investment policy statement, and 95% plus of our clients are balanced in nature, which means that they have some component of fixed income, some US securities and some Canadian securities. And within those portfolios, the Canadian and the US side, as you mentioned, we can certainly flavor those one way or another, depending on where we think we are. So it's sort of a tactical flavoring within a strategic approach. We've, for well over a year, Catherine, taken a barbell approach within the US portfolio, where we have some value, some growth, we have some risk on, some more stable components, and it's worked quite well because, as you know, the market's been a little schizophrenic. It doesn't really know what it wants to reward, and it flips from one area to the next, depending on what day it is or what week it is. So what our approach has done is really smooth the ride. It's decreased the volatility, and it's been quite good. We've added some alpha as well. I'd say that where we are right now, we think that we're pretty much in the midst of an economic cycle, an expansionary cycle. I don't think we're in the late innings. I'd say we're probably in the middle innings of that. The health issues that the society is experiencing and their effect on the economy may have an effect of elongating that cycle. But there's lots of good things yet to happen in the cycle. We've got to, of course, restock. We've got an inventory restocking that has to happen. We see huge supply disruptions and demand disruptions. They have to settle out, and we really aren't in a position, I think, to try to take every piece of economic data and draw conclusions from it, because it's all over the place. One month we see like really strong retail sales, like we saw last month, that blew away the estimate. Well, next month it might be the exact reverse, because as we know, the Delta variant has changed buying patterns. So we tend not to make a lot of changes based on different data points. We just sort of let ourselves be taken with good companies that we know eventually will outperform not only their own history, but their peer group and the market as a whole.
And Gord, I should ask as well, for your clients, it's funny when you do interviews on TV and, you've got like maybe 5 to 6, maybe 7 minutes, depending. I'm not aware, but I always like to understand how people's firms operate for their clients. In other words, do you run pooled funds, or are they segregated client accounts, whereby, so that everybody knows what that means, if you have a segregated account, you actually own stock XYZ, as opposed to it being pooled and you own a unit?
Exactly. And at this point, it is the latter, Catherine. Every individual client owns securities. There's no mutualization, no pooling of assets. Now, if a client A owns 30% of their portfolio in the US market and client B owns 50%, obviously they own more, client B owns more of the US portfolio, but the names are the same. So every client who has a participation on the US side will own the same portfolio, just in different percentages, different weighting. based on their asset mix.
Okay, but just to be clear, because you said the latter, and I think I said that segregated versus pooled.
Yes.
It is segregated. They own the stock.
Correct.
Okay.
Now we are in the process of registering across the country as an investment fund manager, and that is going to allow us to offer a pool, and I expect early in 2022 to be able to announce that we have a pool for people with lower amounts of money. Our segregated accounts, our individual accounts, now start at $500,000. And of course, there are people out there, a lot of people out there with 300,000 or 200,000 or 400,000 who would like to participate in Good Reid management but can't right now. And we're going to set up a pool to accommodate those individuals, and it will be a balanced approach, Catherine, so that it will mirror the average or the median composition of our segregated accounts on a balanced basis.
Got it. And just one more follow-up question then. Will that be an actual fund, or will you structure it as an ETF?
No, it'll be an actual fund.
Okay.
And it will be available, I anticipate, through our website, through a portal.
Okay.
But it'll also, even though it will be a pool, you will own units in a pool, it will be viewed as a segregated account. So it'll be viewed as a high net worth account. There will be, the normal account opening, KYC, know your client obligations on our part, and fiduciary responsibilities on suitability on our part. But as I say, it'll be available to people with lesser amounts of capital.
Got it. And just for people to understand, segregated accounts tend to have higher costs associated with them in terms of just the operations versus pooled.
We can operate pretty efficiently. Our fees start at 1.25%, and once clients get to the $5 million mark with us, Catherine, they're well below 1%. So
okay.
Pretty efficient.
Yeah.
And the other thing that it offers is that in accounts that are non-RSP or RIF accounts,
registered
accounts. Thank you. Non-registered accounts, the fees are tax deductible against.
Got it.
So
yeah.
It gets to be quite efficient.
Yeah, and I didn't even mean it the cost to the client. I meant it just operating from a regulatory perspective. But anyway, that's in the weeds. Let's talk about a few stocks that you brought to us today in terms of why you like them, why they're in your clients' portfolios, and let's start with Freeport-McMoRan.
Yeah. Very large copper producer, of course. And the thing that drew me to Freeport, well, there are a couple of things. One is that from an operating standpoint, their Indonesian mine, Grasberg, is now at 100% efficiency. It's producing at 100% capacity. So they're producing large amounts of copper. In the United States alone, they're producing 1 million pounds of copper a year. Very profitable at current copper prices, which are just north of $4 a pound. They're going to produce probably $12 to $13 billion of EBITDA, and at current prices, they're trading at roughly 4 times enterprise value to EBITDA. So very, very attractive from a valuation standpoint.
Why is it still so attractive? I mean, I feel as though investors have been looking at this commodity cycle and looking at in terms of wanting to buy into it. Things got legs. Obviously, you're seeing that in the energy sector. Copper, is always a bit of a leading indicator in terms of where we're going on the global growth scale. And, obviously that's been put into question given the COVID, as well as Delta and also China slowing down. But I still feel as though there's a lot of people who believe in what you're suggesting, which is supply shortages might elongate this business cycle. So why is it then that Freeport is trading at an attractive valuation?
Well, good question. We think it should be trading at a more attractive or a higher price, less attractive valuation. And part of the reason we think that is the secular story, and that is that copper, unlike a lot of base metals, isn't an additive to a polluting world. It's really a green metal, if you want to think of it that way. 70% of the copper produced will be used in applications that will deliver electricity. An electric car uses 4 times the copper that a gas-powered car uses. Gas or turbines, wind turbines, many applications, of course, use copper. So we think there's a secular story here that's underappreciated.
And when you think about where the true demand is coming from, is it going to be driven by China?
I don't think it'll be driven by China. I think China is certainly a very big player, and I think that has added to some of the weakness that we've seen in the whole metals complex recently. But I think it has legs throughout the world. But China is certainly a very big economy, so it's going to be a big buyer of copper and other base metals.
Let's talk a little bit about Google as well. This is another name that you like. And, it's interesting when you take a look at some of the FANG or, large cap tech, mega cap tech companies over the past year or so. And, depending on what's going on in the market and looking at valuations, and also, of course, concerns surrounding regulatory scrutiny of big tech. They've kind of moved sideways or down on some days when growth, when people understand that growth can be scarce, then they get a nice pickup. But what's the latest with Google in terms of, let's start with investor sentiment surrounding the stock?
Well, Google has had a very good run at $2,800. It wasn't that long ago that it was half that price, and so it's done quite well. But there's been some catch up there because a lot of people are in kind of a knee-jerk way talk about, and commentators, I hear them on television all the time, say, well, those expensive FANG stocks or those expensive tech stocks. And I always bristle a little bit because Google this year will make over $100 a share in earnings. And at $2,800, the math is pretty easy. It's trading at 28 times earnings. So maybe a 20%, 30% premium to the market, but it's growing at low 20s to 25% annually, revenue, earnings, and cash flow. So it's growing at many times the rate that the average company in America is growing. And we all know from compounding exercises and so on that if a company or anything grows at 25%, it doesn't take long to grow into a valuation. So 25% grower will double your result every 3 years. So it's a great company and it's not expensive. So I think there's a couple of reasons why. You mentioned one of them, and that's the regulatory overhang. We've looked at that extensively because we also own Facebook and we also own Apple. We own Amazon. And they're all sort of under the same umbrella of sort of regulatory scrutiny. But our conclusion is that, regardless of what happens, there's still great value for stakeholders there. So if you say, well, what if they were to break up one of these companies? Well, there's a lot of studies out there that say, well, it'd be worth more as parts of a whole. Are they going to become more, or are they going to have restricted covenants put on them? People like these companies. Everybody says, well, everybody's a Facebook hater, but they've got 2.8 billion monthly average users. Somebody likes them. So the users tend to like them. If you listen to the arguments, it seems that there's strong arguments on both sides, but for exactly the opposite reasons. You listen to a Republican talk about Facebook, and the argument is, they're censors. And you listen to a Democrat talk about Facebook, and the argument is they don't police enough. So
Right.
two, completely different arguments, but both of them are negative on Facebook. So, Facebook or Alphabet, any of these, it's new technology. As a society, we're trying to figure out how to responsibly use these companies, how to responsibly police these companies. And I think we'll get it. But the one thing I'm pretty sure is that they're going to be around for a good long time because the model is just so effective.
Well, and that was going to be my next question as well, because I think sometimes, like in terms of how long they'll be around, and I mean, they might be around for a long time, but then it does come down to what's the price that you want to pay. And, I hear you at 28 times, that's not expensive. If it's growing so significantly, trading at a 30% premium to the market value, doesn't sound too extreme, particularly given the era prior to the tech boom busting, when the premiums to the market multiples for some of these large cap tech companies were so significant. I think in many cases, 70, 80%. But that is the concern surrounding some of these big tech companies that trade at a premium, the Amazons, Facebooks, Googles of the world, not so much Apple, but I think back to Cisco and Microsoft, and those stocks did nothing for a decade. Is there any risk in making, in looking at what happened to mega cap tech back in the early 2000s to now? Because that is one of the pushbacks that people will talk about as it relates to these current tech companies.
And I think that you absolutely should be looking at that and learning from history. And there are companies out there that trade at extreme multiples. I think of a lot of the fintech stocks out there that do trade at, I'll say Cisco-like or Microsoft-like turn of the century multiples. I think Cisco got up to close to 100 times earnings.
Yeah.
And Sun Microsystems got way up there, and Microsoft got way up there. So we tend not to buy companies that we think are priced for so far into the future that you lose visibility. But the companies that we do own in the tech or the communication services side have much more reasonable valuations, yet we're not giving up a ton on the growth side. So we're very, very comfortable owning these companies, but you're right, you continually have to challenge yourself from both the fundamental side and the valuation side.
Okay, important point to make, and especially too when we think about tech, some of the cloud computing companies that also have extended valuations. It doesn't sound like you're in that area.
No, and you look at, and often some of these are very, very exciting companies. Take a company like Palantir. Big data. U.S. government is their primary client. There's a huge future for this, but they're trading at 30 times revenue.
Right.
From my
revenue, not earnings, to be clear.
Not earnings, no revenue.
Yeah.
Revenue. They don't
important
have
distinction.
Yeah. So to your point, I think you have to make sure, you have to ensure that you're making a true value decision, and it's not just let's get excited about this technology and buy it at any price.
Yeah.
You go into your everyday life and outside of the market, and we do valuation analysis all day, every day, whether we're in a clothing store or a restaurant, and we can absolutely love a piece of clothing and like everything about it, what it's made of, how it fits us, and everything else, but at a certain price, we will not buy it.
Right.
Conversely, if it's at what we view as a very attractive price, we may walk out of the store with 2 of those articles. So we do valuation analysis all the time, every day in our lives, and you have to do it in the market as well.
Yeah, it makes sense. Let's take a look at one of the big banks in the United States. With JP Morgan is on your buy list, or a name that you would be recommending for clients today. I always think it's interesting to take a look at the big US banks. Everybody always seems to have their favorites, whether it's JP Morgan, Bank of America, or Citi. Why is it JP Morgan for you?
Well, full disclosure, we also own Bank of America. We don't own Citi.
Okay.
But JP Morgan is the granddaddy of the money center banks. I would argue probably the highest quality banking franchise in the world. Uh, uh, they do extremely well in a lot of different settings. Right now, they're doing extremely well because of their capital markets and investment banking business. The capital markets are on fire. There's huge liquidity out there, as you know, Catherine, and you know, a lot of the big banks are participating in deal flow. So that's where they're making their money. Where they're not making their money is in loan growth, and that's because of COVID and the stutter step recovery from an economic standpoint. So they're not seeing a lot of loan growth. They're also not making a lot of money on spreads. The interest rates are low and the yield curve is relatively flat. So they don't get the margin spreads that sometimes they do in a cycle. But one of the reasons that we particularly like JP Morgan is that everybody went into the pandemic thinking, wow, this is going to be incredibly difficult for businesses and individuals. And JP Morgan took all kinds of reserves. You know, the reserves got up to, I think, $35 billion in anticipation of write-offs based on failing businesses and failing individual finances. And of course, what we saw worldwide was that governments basically socialized all of that debt. They took people and businesses off that debt through government programs and in Canada, CERB and different programs for businesses. JP Morgan, among all of the banks, was sitting with all of these reserves that they were over reserved. So throughout 2021, they've been releasing those reserves back into income. So it's propped up the income. So that's not an issue. As I mentioned, capital markets are doing great. And at some point, interest rates are going to rise. So they'll get a bit of a boost from a margin, an interest margin business. Loan growth, I think, will start to improve as the economy comes out of this and people have more confidence to borrow money. So there's a lot of ways they can win in a lot of different settings. And for that reason, we like JP Morgan and we also like Bank of America.
And just to pick up on the comment about the strength that we're seeing in capital markets, you know, certainly the IPO calendar has been massive over the past year. And I'm just wondering if you've wanted to get any direct exposure to more of a, you know, pure play investment bank like a Goldman Sachs. You know, we think of Morgan Stanley as an investment bank as well, which they have a great investment banking franchise, but they also have a huge wealth management business. So have you played any of the more pure plays?
Well, we do own Morgan Stanley as well.
Okay.
And you know, I like Goldman Sachs. It certainly pops up on our screens on a regular basis. One of the things that Morgan Stanley, as given you mentioned it, does for you is, as you mentioned it also has that wealth management side. And James Gorman, who runs Morgan Stanley, has been very active. He bought Eaton Vance, he bought E-Trade, to the point where now on a revenue basis, investment wealth management makes up more than 50% of their revenues. So it gives you a bit of a hedge against that capital markets business, because as you know, capital markets business can come and go, and we like the idea of having a little bit of a hedge with Morgan Stanley.
Understood. And then just lastly here, you know, we're very focused on, well, we have been focused when we look at the auto sector on whether it's going to be traditional autos or electric vehicles. And then, of course, over the past couple of years, you've had more of the traditional players move into EV. And there's still a real debate in terms of whether or not they'll be able to be successful at that versus a Tesla. And GM is a name that you're suggesting to investors today. Why is that?
Oh, we're very excited about GM. We think GM and Ford much misunderstood. We own GM. We did peer comparisons and chose GM over Ford for a variety of reasons. But as you mentioned, they're getting into the electrification process. By 2030, I believe it is, 40% of their fleet will be electrified. They are setting up to be very profitable. Even starting next year, they're going to produce $20 billion of cash flow, Catherine, and this is on about $75 billion market cap. And people aren't even talking about the fact that they own 85% of Cruise, which is an autonomous vehicle program, which has been extremely successful. And there have been outside players like Walmart and Microsoft making investments, small investments, but based on the valuation on those investments, Cruise is valued at about $30 billion, and they own GM owns 85% of it. So what, 40% of their market cap is covered by the value of Cruise. So on a valuation basis, GM is trading right now at about 6 times enterprise value to EBITDA. Just to do some comparisons, you mentioned Tesla, they trade at 95 times enterprise value to EBITDA. So it's Tesla is a cult stock, and you can think what you will about the quality of their product, but as we talked about earlier in the interview, you always have to do a valuation analysis. And in my book, anyway, Tesla gets a failing grade, and GM gets a well over a passing grade.
Yeah, because we have to remember that so often, there is a reversion to the mean when it comes to valuations, and you make money based on what you paid for a stock. It's pretty simple. I think. Gord, we're going to leave it there. It's been great to be able to catch up with you and get your thoughts. Appreciate your time as always. Catherine.
And yeah, I've enjoyed it. Thank you.
Thank you. Thanks, you too.